Okay, what's happening, everybody? Buying versus renting a home, the financial impact analysis that we're building here. This is day two or part two of it, and we're going to keep building. Before we get started, you can support me. Check out smarthelping.com where I have all financial models, templates, and tools. The one we're building now will be part of the personal finance bundle, which is right here. It'll be listed for a $45 one-time fee, as well as part of the bundle and part of the all models bundle, which you can get for $9.99 and includes all the templates on the entire site. Okay, let's do a sound check. Sounds good. Looks good. We'll send it out to Twitter. Live financial modeling now. Buy versus rent home. Okay. So this is pretty much applicable to every human being that ever has to pay to live anywhere, um, and has option to buy or sell. Or not buy or sell, buy or rent. So our buy scenario, if we just quickly overview, you've got assumptions for the purchase of the home, any down payment, loan terms. The term defines when the whole thing is paid off. The amortization defines your monthly P&L. If they're the same, then it's just they're the same number. But let's say you want to pay off the loan in 20 years, it'll give you an amortization for 30, but then the end of year 20, you'll have a bullet payment to pay off the remaining balance, whatever it might be. So it's very flexible amortization. You've also got ongoing costs to own a home like property taxes, insurance, repairs, potentially HOA, and utilities. In all these, you can enter the starting monthly amount and the expected annual growth of those. And that'll give you a cash flow stream here. And you can see like the down payment plus the starting principal and interest. And then you've just got principal and interest over time. Then you've got some home appreciation per year you could put in here. And at the end of the term, we're also assuming that the home value will be realized as cash. And all we're going to do is compare the present value of these streams. We're also going to compare the total end value in cash of this versus renting. Now, renting is a little bit more simplistic. You don't have any down payment. You have just a monthly rent amount, an annual growth rate of that rent amount, utilities, and growth of utilities. Now, if your utilities are included in this, you can just zero out the utilities. And then this shows the cash flow of renting over time. And then this automatically will end whenever this term ends because we're comparing the same exact time frames. So it's apples to apples. Now, here is the part we're going to get into today that's a little bit more complex. And that is what you do. So usually if you buy a house, you have this big down payment. Well, if you're renting, you don't. So that 75,000 difference, you maybe can invest it and earn more. Um, and that's really the only reason why it could ever be financially better to rent is you can do more with that. But you're still with a home, you don't have to think about it ever. You don't have to think about stocks and investments. All you have to do is just live in your home and the value goes up over time basically because of inflation. That's pretty much it. And if you're in a good area, then you have an even better shot of it going up even more. There is, you know, variance there, depending on where you live, but in general, for just the majority of people, a home is going to go up in value over time to some degree. So you don't have to think about your investment. So so the next part of this, we have, um, so what we can do, so on the summary, we did the cash flow of purchasing, we did the cash flow of renting, the difference. Now, what we also want to do, we get some spaces up here. Before I get into the advanced part, let's do the present value of these cash flows. and the higher value wins. And obviously, the rental cash flow, whoop, it's going to be negative. It's just how the question is how what is the total negative amount? The total cash flow for this, it depends. It might be positive. It might be. Oh, it's probably. Let me see. So it's still negative, even with the sale. But we're gonna figure out which one is the least negative, and then we'll also add in the investment piece for if you're renting, or if there's any difference. And basically, this difference is what we can apply to the investment. Now, if it's negative, obviously you're not going to be, but if for whatever reason your rent cost is less than this monthly cost here, which it might be, it depends. We're trying to compare the same property, which means it's very unlikely that the rent is going to be less, but it could be. It depends. It's all depends. Um, but that's why you're allowed to input all these different assumptions to account for the variances. So let's look at present value of owning, present value of renting. So it's just the first piece of the analysis, and we want to apply a discount rate, which will impact the value. Now, discount rate is usually used, maybe the risk-free rate is used, which right now it's actually kind of high. The government rate's 4.5% or something, 5%. Um, so that is an annual discount rate. We can convert it into monthly by, and what we mean by monthly is we figure out the monthly compounded rate that equals an annual rate of 4.5, and then we just apply that to these monthly cash flows. And we'll do a similar calculation to figure out how the investment, the extra cash flow is invested over time and how that grows. But for the discount, for the 4.5% monthly rate is, and then let me see if I remember this. Let me see, 1 plus the rate raised to the 1 divided by, and then we're doing 12 periods because that's annual, and we're going into monthly, and then minus 1. Now, I believe this would be the monthly compounded discount rate to get to a 4.5% annual rate. And the way we can test that real quick is if we start with 100, if we multiply this by 0.37 plus this, then in, whoop, what the heck did I do? Times that plus this. So in 10, 12 periods, it should equal 4.5% more of 100. And it looks like it does, so that math works. Let's see. So period 1, 2, 3, 4, 5, 6, 7. Perfect. So 104.5 is 4.5% more. So this is what we actually use for the monthly rate derived from the annual rate that we're going to discount. Now to discount, PV of purchase cash flow, PV of rent cash flow, and actually let's abbreviate this to CF. And again, we're looking at negative numbers, but we want to see, well, what's the least negative, because that would be the most financial beneficial, because it's essentially saying the cheapest. So to do that, the present value of purchase would be, we want to take this value, we want to divide it by 1 plus the rate, the monthly rate, raised to the monthly period, which is right here. Okay, and then we drag that down. And these numbers will get, the negatives will get less negative as we go out in time because you're valuing it at the present value. So you can see In 7 months, 3,400 is actually equal to 3,300. And if we drag this all the way down, we can get a present value for all the cash flows. And the reason why the present value makes a big difference is now you're getting a proper discount for this future value of the house, since you're not, that value isn't captured until the sale or the term, end of the term. We'll also show the total cash flows equal. Well, we can just do that right here. Let's give a couple more spaces. So let's structure this a little bit better. Let me put, and we could do this too. Period, cash flow, monthly rate. Okay, so we have our present value. So we're going to look at, how do I structure this a little bit cleaner? So we can say buying home, renting home, and then we could say present value of future cash flow, total value of future cash flow. So this is non-discounted. And let's add these up. So present value for buying a home is this. 614,000 for renting. You're at 1,000,000. So the smaller number would be buying based on this, meaning renting's more expensive, holding all else equal. Now, if we were to say total value, we take the total value, total cost of owning a home, including the ending value, we're at 679. And then for rental, we're at 1.9 million. So based on these assumptions, and I try to keep them as fair as possible, assuming the monthly rent and growth rate and utilities were the same, it is what it would be for this type of home. Now again, this is very dependent on interest rates. It's very dependent on where rents are for a house. There's a lot of variables here, but that's why you can adjust this and see. Let's say you were able to, you had a home that you wanted to buy here, but you also you had a potential rent scenario where it was only 3,000 a month. Okay, well that's going to be significantly different now, and you can see now it's still more expensive. Let's see, renting is still way more expensive in total cash flow value, but in present value, it's getting closer to the cost of the home purchase scenario. It's still not as good. I mean, you could run this to figure out, well, at what point does it become viable? Let's try 2,500. At 2,500 a month, you're now looking at almost, the present value is almost the same, renting versus buying, if the rent is 2,500 for this type of house. Now look, starting interest rate 8%. If this interest rate was lower as well, which this is a pretty high interest rate, let's say it was, 5, these numbers get even more skewed towards buying a home being better. Okay, so now the only hope that renting has is, let's say this difference amount here, whatever it might be, and you can see it actually changes over time depending on the growth of rent versus the growth of your home expenses. And one reason why you see this happening is because when you buy a home, the principal and interest payments are the same if you have a fixed rate mortgage. Now, if you don't have a fixed rate, you can assume adjustments in the interest rate over time if you want. You can adjust it in this box here, or you could just keep it whatever the starting amount is and it'll automatically change. But there's so many factors to take into consideration when you're doing this. So that's why you need a model to hold all these variables in place while you adjust different things. And this gives you a good financial picture over the whole life of doing this. Okay, so buying a home wins hand over fist in almost any scenario of this. Like you have to really skew the rent so it's really, really cheap versus what the P and what the mortgage costs and these ongoing costs are to get it anywhere close to even on the present value front. And then if you look at the total value front, it's just never going to be even close. Like there's no way that's going to ever get close. And the reason why the present value is close is because the main thing making this big difference in the total value is just that ending home value. Again, based on the appreciation assumption here per year. Okay. Now this is odd. Did we do this? Why is purchase cash flow going down and back up here? Let me just make sure this is looking right. So that's taking present or the value divided by 1 plus the rate raised to the 347th period. Is this slightly different? Well, these are the exact same. Oh, wait. Okay, here. Why is this higher? Ah, right. Okay, okay, that makes sense. Because we have assumptions that raise the ongoing cost to run the home. Every 12 months they're going up. So you've got an increase in the total cost, but then when you look at the present value, that's going down. So it's going to be some, number. So that's why you see that going up and down, which is completely fine, and that's mathematically correct. All right, now, so investable amount you can invest would be the difference. So let's say you could do this scenario or you could do this scenario, and the assumption is that renting scenario could possibly be cheaper. If so, you can invest any positive amounts here. Now, the other side of it is if it's negative, that means you actually have a little bit of money to invest on buying versus where you wouldn't have that money if you were renting. So if this is negative, technically, that's more money that you could save by buying and you could invest that. So what we have to do here is to be fair, if it's negative, we have to say, well, that's investable money on the buy side. So we could say investable rent side, investable buy side. Okay, and so this is just saying if this is greater than 0, then that means renting is cheaper for that period, so we want the value. Otherwise, it's not available to invest. And so on these negative values, this is where by renting you're actually paying more, so you can't assume you have nothing to invest extra by renting because it's actually more expensive to rent in that month. So only if this is positive, that means you have a little bit extra to invest compared to buying, so we can say that is investable. Now, what we do here for the present, well, let's put this, where do we want to put this? Discount rate, monthly. We'll just do definition. So I'm going to abbreviate. I'll do abbreviation definitions at the end. So present value, future cash flow, value of future cash flow, non-discounted. Discount rate, monthly rate. So these are the main, this is the main section here. And then we have investing assumptions. Now we're just going to assume some annual gain on investment. So that's assuming you have any extra cash flow from each scenario, you can invest it and get some return. let's say now if you just buy the S&P, you could say I think it's like a 10% average rate of return over the long term, but most people try to mess around and end up doing the worst. But you can just put some assumption here. It's going to be different for everybody. But let's say you think by investing your money, you can get a 3% compounded um, return on your capital. Now, we're assuming that this investment is not, um, well, I guess there's a couple assumptions here. You could assume that the investment is reinvested in compounds over time. You could assume that you just take that money out and it's just extra money, and then that would affect our final difference, adjusted difference after investments. I guess we could show it both ways. That's fine. So we could say we might need a couple more columns here. We could say what happens if the difference is invested and compounded and gains over the whole term for as long as we're running the analysis for? Or what if the extra cash flow is just the gains from those investments will then offset this final difference amount? So you have a difference and you have a difference after investment, which would be any gain here. Now we'll have to do an adjusted difference anyway. It's either going to be the value at the very end is going to be bigger, or we have um, the value each month is going to be different. And it just depends on your assumptions about your investment or what you do with this gain. And this can be over here. I'll do some formatting to make this cleaner at the end. So investable side, so we say annual rate of 3%. So we could say, well, we're gonna have to do kind of an amortization schedule here. I'm gonna be back in not 3 seconds, in a minute. I have to go to the bathroom. So let me take a little break here. I'll be right back in 5 minutes. While you're waiting, go ahead and feel free to check out smarthelping.com. I've got hundreds of financial models and templates there. And I will be right back. Now we can show the calculations while I'm waiting too. All right, 1 sec, guys. Okay, sorry about that. I am back. Let's continue on with the analysis. Okay. Let me see here. All right, we didn't miss anything. Okay. So, clear this. We have investment amount, and we're going to say reinvest, yes or no. Now, this should be enough assumptions to get everything we want built. Do this little data validation. So we have investable side. If you're renting, this is how much you have available. We have gain. And remember, this is annual. We want to convert this annual rate to a monthly compounded rate that equals the annual rate. So we do this calculation like we did here. This shows you at what monthly compounded rate, what the monthly compounded rate will be to get an annual rate of 3%. Of return on your investment. And so if we start doing this, we say gain is if, well, let's see. So we do the rate or the amount you have times the monthly rate. Ending balance is this plus this, but we're going to say withdrawal. And then if this equals no, not reinvested, then you just withdraw this amount. Otherwise, zero. Now, I can't think of a situation when you would withdraw. Usually, it's just all going to be reinvested. So if we said reinvest, yes, you're withdrawing nothing. Ending balance is this. The next beginning balance then. So this has got to be that plus that minus any withdrawals. This is then, that's the amount you can add plus the ending balance. So let's walk through this. So you got 75,095 to begin. You didn't buy the house you're renting. This amount of capital is free. This is just a down payment essentially. So first month you make a gain. You are reinvesting, so you're not withdrawing anything. Ending balance 75,281. Next period, you have this. Here's your gain. Here's your ending balance. Now this should go up. Let's say this number was 10%. You should see a value of 82,605, I believe, if we did the math right. Let's see. So 75 times 10%. Monthly rate. So this is end of period 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 83,707. Oh, we also have additions to the investment here. So actually, we won't be able to test the math unless we zero out everything. 82,605, that's the number we want. Okay, so we know the math is working, and that's fine. It'll work. And when we're adding money to it, that's fine. It's just saying that you're increasing your beginning balance that can be invested each month. And that's why the gains are going up over time. All right, so now if you do this, Let me see if we put no here. I want to just think about the structure of this. If we were to put no and withdraw, you're only gaining on this. So your gains are going up, but they're going up slower. They're not compounding as fast, but you are withdrawing this amount of cash. And so then this amount of cash would go back to the adjusted difference. This is going to get kind of crazy. Hold on a second. So we have adjusted difference is going to be, here's the initial, let's think. So if this amount is going out as an investment, we're now not getting that in, we're investing it. So the new cash flow difference, well, we have to do a new rent cash flow, I guess. Right? Because you're now investing that money. So the money is going out, and the idea is you want to outpace the value of the home going up, is what you are essentially saying. Let's think about this. So how do we show this? How does this make sense? This is definitely tricky. Definitely tricky. So let's think here. Let's assume dividends are reinvested. Let's just do this scenario first, just to see. So gains are reinvested. So you're making this amount. Your new cash flow for let's see, adjusted rent cash flow would be, so this amount because you're renting that minus the invested amount plus we want the ending balance if this monthly period equals our end period. So if that equals that, then we want this ending balance in N10. Otherwise, just give us the other total. And now this gets very interesting. Let me make sure this is locked. That's locked. Oh, nope, didn't do something. So this only counts, we only need to do the K calculation once, subtract K9 because that's the initial. Wait, what are we doing here? So this is 28, that's that amount. D10 is the rental cash flow minus, not this, this is a beginning balance, minus this. This is what's being invested. Plus, if it's the end period, then give me the ending balance. Okay, so this just looks better. Yeah, okay. So everything's the same, except now you're investing this difference. Let's call this the beginning balance. And we'll call this whole thing gains from renting, investing extra cash flow available renting scenario. I don't know, we might think of a better name. Anyway, so We have this gain. So we have an initial difference here. And we're saying, okay, if we're renting, this is the amount we're saving by not buying a house. So now we're going to invest that. So now the cash flow is you subtract that. You're investing it in your own investments instead of the house. So it is cash going out. You're adding the gain. Why are we not adding L? Because we're assuming everything's reinvested. So it's this. It's basically saying this is, yeah, 2895. So it's saying that your cash flow for renting is now the same as if you were to buy because you're getting back to the difference and you're reinvesting that. And then if you go down, we now have, look at this. We now have ending balance of 763. Wow. How is that almost, is that this, hold on. Is this the same somehow? Yes. Wait, what math did I do? Why is this the same? Okay, so this difference, this ending balance is actually much higher because it's, I mean, we're assuming a 10% annual gain, so it's going to be, but so this adjusted rent to cash flow, we want to add N. We don't care about E. This is just, oh, all this is saying is we're going to sell the house at the end, and here you're going to sell your investment at the end. So even though this is creating a negative difference, you actually don't because you also have the stock amount. So let's say at the end, this is 763. If you were to have rented the whole time and got a 10% return on the difference in cash flow from buying, you have 1.3 million at the end. So your rent cash flow I believe we zero out this amount. So if only on the end month, if that equals that, then N69 plus this. No, that's not right either. We got to get to a number that is just if I'm renting. So I'm renting out. Here's my investment plus the rent cash flows. Okay, but now I'm growing at an investment rate that potentially is more than the home rate. And I'm investing a little bit more because this is in this scenario where, and again, I did a kind of crazy scenario where you're renting a place, $375,000 house for 2.5K a month, which may or may not be feasible, depend on the market. But anyway, the point is here we're creating a surplus. This is investable. We are investing it and then getting it back. So the question is, what cash flow is at the very last period? We're getting this very last period, we get 1.3 million back out of the investment we've been investing in. And I guess that's it. We don't really care about the difference here. It's just going to be one period's worth of difference. It's not going to be material to the analysis. So if this is the end period, all we're saying is so you've invested this whole time, you've paid your rent, you're growing some assets at a growth rate. With this, you're making these gains every month. $3,603. Your rental. So now, okay, we got to do we need to make a change as soon as this goes to zero is the other question. So when this is negative, what are we doing? Right, yeah, so this has got to be adjusted because we are now We only want the rental cash flow. We don't want we're not looking at the difference yet. So if column E, okay, so we want to say also, so for E we want to say minus the maximum of this or 0. I believe it's the correct calculation. And for period 1, I don't think it's irrelevant whatsoever to have that, because you're always, the scenario where the rental cash flow is greater than the buy cash flow is not, like, that's not going to happen. Okay. And if it does, it's not even, it's going to be a very small difference anyway, so it's no big deal. All right, so let's see if this makes sense. So if we drag this down, what happens when we start to get a flip in cash flow? We want this to be the same as, perfect. So this is now saying, okay, now that renting is more expensive than buying, this extra cash flow, there is no difference to invest. So your actual cash flow for renting is going to be what it was here, which is just your rent and utilities. Okay, so that makes sense. So there's that, and then the last period, it's that. But we want to add into this last function, add this, zero this back out. Okay, so this is, wait, how is this exactly the rent amount? What are we doing here? So we're technically saying the rental cash flow minus 0. Let's make sure this is what this equals. Okay, so that's 0. So A, B, C, D, 49 minus 0 plus, if B10 equals by D9, which is the end period, take N, 1.3 million, plus 763. Okay, why is this so negative, or why is this zeroed out though? Oh wait, if B10, oh my goodness. Okay, I see what happened. We locked, for some reason, B10. Should not be locked as a number. Okay, that should smooth some things over. Let's try this again. Okay, now we're getting somewhere. So on this last period, essentially, your cash flow is, you get this, we are subtracting the rent for that period. Now, what's the difference of these two? 9,900, that seems not right. We should be somewhere around 0.346, which is, you're getting this. Oh wait, I added subtracted. Okay, so that is right, 1336. Because you're paying this, but you're getting this out, and there's no difference to invest. And these are just the rent payments all the way through. Okay, we're gonna get, guys, we're gonna get there, I promise. Okay, so now, assuming an investment scenario, here's your adjusted cash flows for renting. We also, so look, there's also this difference here. Like if in this case the rent eventually gets more than the buying, so there's $200,000 here that you could potentially have invested because you're saving money by buying. And again, this is going to be completely dependent upon your assumptions for um, what your monthly rent is and the growth of that versus what your interest rate is on the loan, your down payment, all that in the growth rates of these operating or ongoing costs to own a home. So it's going to be dependent on all of that, but it's possible for sure that it's cheaper to actually own the home than rent, and then that difference should be invested. Otherwise, it's not a fair comparison because you're saying that you can invest the difference if the rent's cheaper, but not if the mortgage in owning cash flows are cheaper. So that's not fair. So we have to do that as well. So we're going to do investing extra cash available by scenario. Now let's say, just for fun, let's say this growth rate was only like 1% and you're starting out as 1500. Let's say this was included. You're living very cheaply. You cannot. This would be completely two different houses though. Like this $375,000 house, you're not going to rent it for 1500 a month with 1% annual growth rate and no utilities. But let's just say, for fun, you can. You now should have a difference the whole time. Yeah, so now in this case, you are getting a difference. And now, I mean, and if you're getting let's say a 7% annual return on that extra cash flow and reinvesting it, your adjusted rent cash flow, why is this so high? Oh, wait, whoops, this is the one we're going to do for the buy scenario. For the rent, this is now your adjusted amount. You're reinvesting a ton, and now, I mean, you're getting all the way to 2.2 million at the end of the term, and this is worth almost 3 times what your house is worth. But the assumptions are extreme. Okay, so let's do, but we have to do this fair. So let's say if you buy, what's your extra cash flow? We got a couple people in here. What's happening, everybody? Okay, so if we buy, how's this gonna work? Your balance is going to be based on if this difference here initially is less than 0. And let me adjust the assumptions back to where it was. Let's say this is $3,000 a month, 2%, and let's say it does include utilities. It's fine. So now your rent is actually more expensive, so you're saving money by buying in this case. So you can reinvest that savings just like we can reinvest the savings if we were to rent and save money. So in this case, our gains are this investment amount is only going up by the gains for the rent scenario. It's not going up by this 105. And let me just make sure that's true. So this should only be going up by 7513, and then okay, good. And that's 7513. If let me just put a number in here. Let's say this was 200. Yep. Okay. So then this would then be higher, as well as the gain based on that's higher, and it's all compounding. All right, undo that. So our beginning balance here is still negative, right? Because we're putting a down payment, so we don't have any gains in the first period. Make sure this is right. Yep, that's our compounding growth rate. This needs to be put over there. And then ending balance is just this. Okay, so now 426 is, nope, that's not the right place. So this is saying we can now invest $105 if it is less than 0. Because if it's less, that means it's actually, if it's less, then this is negative. Whoa, wait. That means we're saving money by buying the house and we're going to reinvest that. Now 11. What are we doing here? We want to pull in a positive 105. If this is less than 0, then negative 11. There we go. Okay. And so we got that. We're starting to get a little gain. We're not withdrawing. This is growing. Now we have another amount we're putting in. And now this gets your adjusted cash flow back to, well, we got to move all these over. Let's see. So this is adjusted cash flow here. Let me just do the same thing, except this ending balance. And then we want to do purchase cash flow, not because we're doing the purchase side this time, not the rent. So C minus this. Now this is the tricky part too. So what do we do here? Plus, if B10 equals by D9, then give me the value of the investment. Okay. And then this should just basically be caught up to what the rental payment is, which is 3,000. This is 2,791, so we're out still. So let me look at this calculation. Oh, we also don't want to lock this. Okay, so if we look at this, all right, that's fine. Purchase cash flow. Do we add the difference now? Maybe. Yes. Okay. Because ideally we want to say, okay, we're getting this extra money, we're investing it, so our cash flow is actually going to be match what the rental cash flow is. And instead of renting, we're just putting that extra difference, which in this case is 105. 105, we're investing that into some investment that's getting this return. Okay, so that's good. 360. So our difference is getting greater and greater. We're starting to get more gains. The adjusted amount is fine. So this is now just matching what this is. And eventually at the end, we get this amount back. Now, hold on though. Hold on. So we have got, we got to zero out the, and we just want to show the value of the investment. So let's see. So this beginning balance, on the last period, so let's see, how do we do this? So plus E or minus E, we want to say if this is equal to our end period here, then 0, otherwise that. Whoop. What the heck? Hold on. Undo, redrag down. So we're going to say if E369 is less than 0, then pull the difference, except we don't want this big difference here on the end month. We want to say if this equals this, then 0, otherwise do that. And then we can lock this. We're gonna close this. if this is less than 0, then check if this equals that, then 0. Otherwise that. Otherwise, I think we got to close this. Perfect. Okay, so all we're showing here is essentially the difference in cash flows being invested. And the main difference of what can be invested is going to be based on the difference in initial cash flows of buying versus renting initially. And then at the end, so here we actually are getting $670,000 from this difference. All this is all saying is cheaper to buy in this case than rent. Now, if we were to say, I want a scenario where it goes both ways. 2,500. So here now we're saying, look, we're actually our adjusted cash flow for buy scenario is actually the same. So this should be why is this doubling? Okay, hold on. So C purchase cash flow minus the difference. We definitely want these two, but on the initial purchase, I think we have to add this down payment back in. So it's not, hold on, let's see if this makes sense. So I know it will make sense now because your adjusted cash flow is now just the same because it's not any, wait, 78, 77, 895. These initial months are a little tricky. I'm trying to figure out what's the best way to do this. All right, so 77 is what we want. The adjusted stream is going to be this. And it's not. Here's 25. So we don't want it to go to the rental cash flow if this is positive. So let's redo this calculation. And then once it gets negative, we're actually starting to invest those differences. But up until that point, we just have the regular cash flows of buying. Did I drag this all the way down? Oh, come on. All right, let me make sure it's still working the other way. So let's undo this, undo, undo, undo. There. Okay, so here's where we were stuck. This amount should not be 152 because we're not investing this difference. This is a positive amount. We only want negative amounts. What do we do on the adjusted rent cash flow? We did D minus the difference. Okay, so that's where our trick is. This is assuming this is always going to be positive for rental, but it might, if it's the buy side, it's not. So we have to do an if there. So we only take E if E10 is less than 0. Okay, so now set. Now let's see what we got. And then do we have this 2? And then minus if that's less than 0. But we have to do if E69 is less than 0 and this does not equal our terminal month. Then you can do that. Oh, still not right. So C is the actual, actually we don't want C, we don't need, well yes, because this is saying you have extra cash flow that you've invested, you've also got this cash flow. So hold on, this is correct. It's just, so you're getting, selling the house, you're getting this value, plus you're getting this exit value, minus, or plus this cash that was invested. Now what's the difference here? 5,328. So 368. If that's that and that's not that, then take E. Otherwise, if B equals that, then plus, because we are investing this for this period, this 5,328. So that should match. Like that's being invested here. I believe, is it? What is this 1879? Oh my goodness, this is confusing. Hold on. So this is, we're saving 1,700. Okay. So we are investing 5,328. So we have to adjust this. And we're subtracting it. It shouldn't be subtracted though, so that's not right. Because this cash flow needs to be this. And what's more here? So the rental's more, so we're not losing. But once this, oh wait, no, this is negative the whole time. So this is saying the rental is more expensive the whole time. So we want to invest that difference. So we're investing the difference. So our cash flow should be 5,328, not 1879. Yeah, we're in a mind bend. We are in a mind bender here, guys. It's a mind bender. Any suggestions from the comments? No. Let's ignore the first and last month and just look at what the adjusted cash flow should be. So if I am in the purchase scenario, I want to say my adjusted cash flow is, obviously I have to pay my mortgage and all those expenses. And plus, if this is less than 0, which it is, that means the difference is greater. So I'm going to invest that. Add it. Otherwise 0. Let's see if that makes sense. Wait. Okay. So this, for now, this does make sense. Our cash flow is 3,000 and we are investing that difference. But let's see what happens when this is reversed. So now it's cheaper to rent per month. Now our cash flow should just be whatever it is for the house. Perfect. Okay. So this is correct up until the last period, I believe. So 3603. Yep. And the difference is towards rental, so you're not investing anything, and this is all zero. So this is fine. Let's put this back up to 3,000. Whoop. Now it's cheaper to be buying, so you've got your cash flow goes to match what rental is, and you're investing the difference. Here's your gain, and then at the end you're going to get that out, but we have to figure out how to do that. And the issue is here is the term could be less than 30 years, so we need to make the calculation dynamic. I can't just have a different calculation in the last period, which let me make sure I didn't do that with anything else. Oh, we did do that with this. All right. But that looks like it can drag up. No, not all the way. Okay, hold on. Let's go back to this. Make sure this is not different either. So this is the same, 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 same. Okay, so this is good because this is all the same calculation the whole way through. So we can have an adjustable terminal month. This right now works for the adjusted cash flow and the investment, but our first balance is a little weird. So the first period it's never going to be positive for buying a house. That'll always be zero to start, so that's fine. Good. We're assuming this is reinvested, ending balance, and then so this adjusted rent adjusted by cash flow. Here needs to be essentially just this. Because if there's no way your cash flow is going to be worse in period one for renting. It's never going to be more expensive on renting. It's always going to be more for buying. So there's never going to be an adjustment or an investment for this. So we can just say this is going to equal this. That's fine. I'm happy with that. That's going to fit, every 100% of scenarios. Pretty confident saying that. Now, these are fine. We're investing the difference if there is one. If there is no difference, let's just make sure, then yeah, your cash flow is essentially the same as what it was the whole time. And then at the end, so we want this formula is fine the whole way except this last period. Now the last period was 2664. That is the rental cash flow. So if this is if that period matches, we want to do a completely different calculation. So if this equals this, then we want the total adjusted cash flow to be positive this. And this 763 already includes the debt payment. I believe. I'll double check that, but I believe it does. So we just want this plus ending balance here if there is one. Otherwise, just do the other calc. And I believe that gets us to where we want. Okay. And we can drag this all the way up to the almost very top. So what this is saying essentially is if it's always going to be cheaper to rent, then your purchase cash flow is the exact cash flow you see here all the way down. And then it's still the same here, 763. Let's check that 763. I'm assuming, yeah, this includes the costs, this, and then the sell price. Okay, so that's fine. That's good. Okay, so let's test a couple scenarios, and then we'll maybe do the reinvestment if it's no, and we'll see if it even makes sense to do that. So let's say this is more. Okay, so now the first period, yes, you have some investment to go work with, so you're getting money here if you were renting, but you're losing here, so your adjusted cash flow is actually going to it's going to be less, and we're not investing any more gains at this point. It's only reinvesting the initial, essentially you're getting this initial purchase amount or down payment, you can invest it. That's all this is saying. The cash flow is the same, what it is here. Okay, we go down. It's only getting worse for the rent scenario because of annual rent increase. And now at the end, you do have 568,000 based on investing that initial difference in because you didn't make the down payment. So you have 562. So this adjusted stream we will do. So this is like the basic calculation, and then we're going to do the advanced calculation, which will show the adjusted rent cash flow. So that's great. This all is making sense to me. And we can actually now do a difference. Well, we can just show the differences of these two now. So that's good. Now, if this is the buy scenario, yes, you have the initial amount bigger here, but now you're actually getting a little bit of a gain because you bought compared to the rental scenario that's more expensive. So now you can say, well, I can invest that difference. Assuming I were to have been renting, I would have had to pay that amount. And the reason why we have to do this is because it's possible over time that the rent might be more than the mortgage might be more than the rent. It just depends. Completely depends. So my cash flow to buy is this, and then I'm matching the rental cash flow, but I'm now investing that difference as well. So now when I go down here, so this is matching that, that's fine. I'm investing, so my balance is going up. It should be going up by, yep, 3,400, which should be this plus, and to get a plus a negative, we need a negative plus this difference. Perfect, and that is. Okay, so that's good. Go all the way down, and now, well, we have 1.7 million in the buy scenario because we have the value of the house plus the value of this investment that we did because it was actually cheaper to buy versus rent in the raw cash flow monthly payments based on our assumptions. So in this case, it's way, so now let's do some visuals. And I don't think it makes sense to not reinvest this. The whole point is what you can do with reinvestment. So like if we withdrew here, well, okay, let's say if we put a no here, what happens? We're withdrawing. So this is staying the same. This should still be going up by the difference. We have to add some logic now because the adjusted cash flow now should be adding this withdrawal. So we can just take this plus the withdrawal. So now the end investment, obviously, it's a lot less. It's only 74,000, whereas if we hit yes here, it would be 568,000. But there's difference in the cash flow as well, so we'll look at that. And then this we'll put final adjusted rent cash flow with reinvestments or not and everything else. And then here, same deal. Final adjusted by cash flow. And it's just going to be whatever this is plus any withdrawals. Let me make sure I did this right. Okay, withdrawal. All right. Now that's going to be a rare thing. Let's look at the final. So 1405, 1.7. Let's do all the summaries. So this is simple scenario, no investments of differences. And then let's do advanced scenario, and where we're investing the differences. Let's do the total value first, which is going to be this. And then, oh wait, that was renting. Hold on. So this is buying. So buying is this one. Renting. Can I get this over? It's this one. So yeah, in this case, buying is way better. Well, we'll adjust some of the assumptions to see what's going on. Now the present value we can do as well. So present value of rent and present value of purchase. Okay, and then for that, we have the calc here. Let's just do it. To format all this stuff. So this is going to be, let's see, so this is the period, comes over here, and then the amount we're discounting is this, and this is the discount rate on the advanced scenario. So there's that, and then discount. Present value is there, so it's less. Obviously, you're discounting where those big cash flows come at the end. And not reinvesting means you've only got in the renting scenario, you've only got that initial investment you're getting back, and you've taken all those cash flows during the period to reduce the rent amount. And then oh wait, I keep mixing these up. All right, so hold on. Buying is here. Make sure we got all the cells. No, we don't. Get this up here. So present value of future cash flows for buying is that. Value for buying is that. Oh, we didn't even do the. Hold on, we didn't even do this for here yet. So here it's the same calc, except we take this cash flow. All right, and these two I can't stand. We need to format these columns. Please. All right, just 0. Okay. All right. Guys, we are almost there. This is so cool. Let's get these to gray as well. Let me make sure this is taking it right. So this, that, and then the monthly period. Perfect. All right. So present value of future cash flows buying a home is that. Total cash flows non-discounted for buying a home is this. And let me make sure that's including all the cash. Yes, it is. And let me make sure it's okay, good. Now, renting. Present value is here, and I believe, hold on, what's starting here? Okay, and total value, non-discounted, is here. Okay, so there's our advanced scenarios of investing. Now, let's say we are reinvesting the dividends. In this case, with these assumptions, is actually you're making money. um, you have a net positive cash flow, which is crazy. In this scenario, again, this scenario is not common at all. I did a pretty extreme example. But you can see the value is higher for buying versus renting, and then present value renting is closer here. It's closer for sure, but still it's better to buy. Now what you can say is, well, and if you do non-reinvestment, buying is still going to be better. Let's say your rent is a little bit cheaper. Let's say it's $2,500 and includes utilities. Well, non-reinvestment is always going to be, I think, better for, let's see, it's 100,000 difference. That is 40,000 difference. So if you reinvest, it is better. It helps a little bit with the renting, but it's still better to buy on present value. Value future cash flows, still better to buy. Um, this is the discount rate. Now, as you increase the discount rate, you can watch it's going to get better to rent. Yeah, you still have to go up to, let's say, 10. It's almost there. If you discount it at 15%, the future present value is better to rent based on all these scenarios. So it's pretty extreme. We're assuming an annual gain of 7% on investments, compounded. We're going to do some visuals. Now, here, buy scenario is we're saying in this case renting is cheaper in every single period. Well, no, we're getting some investments by month 145. So here we're finally getting, it's better to, the monthly payments are less based on the mortgage against a relative increase in rent. So you're getting some there. You have some investments this way because it was you had some early investments because the renting was cheaper right off the bat. Cash flow. Okay, that makes sense. I'm just trying to make sure everything is what I expect it to be. So here, when the rent is cheaper, you're going to be investing that difference in investments. So the cash flow that's going out is going to equal what the purchase amount is, and that difference is invested. And then for this one, well, you're not investing that because that's your mortgage cost, so you have nothing there. Eventually, you do get some positive on the purchase side, and then you know, I believe all this is looking great. I'm really happy with how all these calculations are working. You can see how difficult this can be. I think this is going to be a very valuable personal finance template, and the use is essentially anybody. You start on the buy tab. Here's all your assumptions about buying a house, the resulting cash flow. You have rent, the cash flow there. You have a summary which shows you the difference. Now this first difference is assuming that no differences are reinvested. It's just saying here's the present value and the total value of the cash flows for buying. Here's the renting ones, and you can just compare them over the full term. Now let's make sure if this term is 20 years, let's make sure all of this is working. Okay, so 20-year term, this ends. This looks fine. Let's go over here. What am I summing up? Okay, so that's ending. That ends there. The adjustment is this. This is adding that. Essentially the ending balance of investments plus the purchase amount, so 9. Okay, that's good. Just make sure that this works with adjustments on the terminal period. Okay, and then on the rent one, okay, these are irrelevant. Now why is this going to 0? It should be, but I'm just making sure I know why it does. So max of E 250, 0 plus if. Oh, I got it. So it's not taking the ending balance, and then there's nothing else to do. Okay, good. Okay, great. So this is working. Let's put this back to 30 and 30. All right, visuals. This is where you can really, really see it. So we'll do. There's a couple we can do. So let's look at first. We're going to show buy versus rent with no reinvestments. So on that one, we just show, and we'll do the total without discounting as well. So buying, here's your cash flow stream. Oh, actually, do we want to show the cumulative cash flow? That'd be good for the chart data, actually. Okay. So over here, let's look at cumulative cash flows. Non-discounted buy. Discounted buy. Non-discounted rent. discounted rent. What else do we got here? Let's make this smaller. Non-discounted buy, discounted, non-discounted rent, non-discounted buy with reinvestment, discounted buy with reinvestment, and then same thing but for rent. Okay, so there's that. We then do just reference the calculations but add them up. So non-discounted buy simple would be this, and discounted buy would be this. Non-discounted rent is that. Discounted rent is this. Non-discounted buy is this. Discounted is that. Non-discounted rent with reinvestment and discounted rent. So then we just drag all of these down one and add the top number. Okay. And the accumulation of each. And the one that gets to the lowest at the end is the winner, which would be non-discounted buy always. Well, I guess it depends on the assumptions, but among all the buys, that one will always be the lowest for all the buys, and among all the rent scenarios, the non-discounted rent with reinvestment will always be more or less. Oh, wait, maybe not. I guess it depends. It really depends on the growth rate of the investment, everything else. So we can compare these. So we'll do one big chart that shows all the scenarios in one cumulative line. And oh yeah, that's cool. And the periods are just monthly, so that's fine. Let's put these on the low. We could give them a little horizontal and a label. Buy versus rent, all scenario comparison. And then we're going to do specific scenarios. All right, so very cool. Buy versus rent. What? Outline. Complex rent applies. Okay, whatever. I just did that. Now, let's change the chart type. We want lines. Can I get all the way to 360? undo that, undo. Okay, so here's your lines. It's kind of hard to tell. Let's get a legend in here. It's a little bit difficult. Is this a stack? No, it's not. Okay. And then we'll do copy paste, and this will actually be the bottom one because that's just like a, you can just see each one. But here, let's compare. So non-discounted buy versus non-discounted rent. We want to see. There we go. It's still kind of, well, okay, so there's no, so here you can see the rent is actually better in total cash flows, obviously, because you're not putting a down payment, but you do catch up and eventually, so this is non-discounted buy versus rent cumulative cash flow. Eventually, though, the rent is going up higher and this is going down, and then you obviously have the sell of the home at the end. So this is a big, you end up with a big gap at the end. Now let's do the discounted, same chart but discounted comparison. So here we'll do discounted buy, discount rent. And now you only catch up at the very end if you're discounting, and then at the very end, obviously you're still going to go higher, but it's a little bit better to rent this whole period until you eventually sell the house at some point. Okay, let's do, what's the next one? Now we'll get into the more advanced. So we have, so we did 1, 2, 3, 4, non-discounted with reinvestment, rent, and buy. So now this is very interesting. You can see the rent is getting up a little bit, but still you're ending up at negative 775,000 total cost. Here you end up at 333. So the lower, the higher number is better. Negative 300,000 is better than negative 700,000. So here the winner is buy. Now let's do discounted buy versus rent with reinvestment of any differences. And then that's it. Now this is the closest one. If you're going to discount, you're reinvesting any savings, you're really close here. Now my question is, wait, why is this, so discounted buy, discounted rent. Let me look at this real quick. So these are the same. Ah, yes, because, and wait, aren't the other ones supposed to be the same? Yeah, okay, so good. So if you're reinvesting, the cash flows the whole time are the same for each, but what's the difference? What makes them different is that you can reinvest the differences depending on which one's cheaper over time, and then the end value of that is going to be, the shown here at the very end with the difference in color. And then here's all the scenarios compared in one chart. It's pretty cool. Now we can also say, don't reinvest, and then you'll see differences the whole time in these. Which you can see here, if you're not reinvesting, it's actually cheaper to rent the whole time until the sale happens. In this scenario, again, with these numbers. But every you have to adjust the numbers pretty heavily to make it more beneficial over the entire life of the analysis period. to rent rather than buy. So this is pretty telling. I think this gives good perspective. This is about as deep of analysis as I could think of to do. That's very comprehensive. Allows you to adjust all the levers. Um, you're adjusting discount rates. You're adjusting the average annual gain on any investments that you can make based on the differences. You can choose to reinvest or not. That affects the cash flow and total cash flows. Um, you've got your renting assumptions, buying assumptions, very dynamic. I think this is very comprehensive um, and useful. And I think the discounting is important because one of the biggest pieces of the the reason why you want to buy is the house home value at the end, and that's discounting that gives you a true value of that versus saving the money now by renting. So that's why I think this is a really discounted buy versus rent. This one here is pretty interesting to see. Okay, I am done with this thing. It'll be posted. I'll do an overview video. It'll be posted at smarthelping.com at some point. You can see, I'll post it on the site under the financial models tab at the top. It'll be in the section labeled personal finance right here for $45 one-time fee. And then it is also included in the all models bundle you can get on the site. You can buy all the models I've ever built. I've got like 130 or 40 and get access to anything I ever build in the future as well for $9.99. So check it out. Thanks for supporting me, and I will see you guys next week, taking suggestions as well on any new models you guys want.